Well, I'll tell you this. I came into this year, like most people, expecting that the Fed would resume normalization at some point, and then the war happened.
Yep.
So it has thrown a bit of a wrench into everyone's expectations, my own included. However, I will make the observation we're still in early stages. We don't know how this is going to impact the real economy. We don't know how it will ultimately impact the Fed. And at the end of the day, 2-year yields close to 4%. That seems like a pretty attractive buying opportunity.
For our listeners who aren't sophisticated, like Tom Keene, not sophisticated, for mere mortals like us, is it catching a falling knife in the dark right now to bet on yield and price?
It does seem to be as though we could have another leg higher in rates, but eventually we're going to have a Fed that needs to address the realities of the real economy. If this war continues and elevated energy prices persist, that's going to have a negative impact for the consumer, and that's going to refocus the Fed on the employment aspect of its mandate eventually.
What did you hear from Fed Chairman Jay Powell yesterday of note?
First, he's going to stay on as long as he needs to. And the market's been interpreting that as somewhat bond bearish because he has been an advocate of central banking independence. He has been a more hawkish than dovish at times, all of which I think is good for central banking credibility. He also made it clear that he and the committee have no idea how this is going to impact the U.S. economy. We don't know how long it's going to go on. We don't know what's going to happen to the Strait of Hormuz. And so the prudent thing, and I think they're right, is to wait and see.
Wait and see, and I'm looking at the WIRP function. The market's kind of saying, we're not going to get any rate cuts this year. I mean, is that kind of how you interpreted it?
That's certainly what the market is saying.
Yes.
I don't think that my takeaway, at least from Powell's comments, were there's no path to lower rates. The takeaway was that there's no path to lower rates until there's until the uncertainty has been removed, and so that might not be until the second half of the year. I'm on board with the idea that the Fed has told us they're going to move 25, and if it happens, it's probably going to be maybe the last quarter.
Let me ask you the same question I asked Gary Gensler. If there wasn't a war, Ian Lyngen, there would be no topic other than private credit. I mean, it would be top of pile for everybody within economics, finance, frankly, investment, and international relations. Ian Lyngen, with an award-winning full faith and credit perspective on the shadows that we see within private equity and private credit.
So you make a very good point. If it wasn't for the war, we'd be trading off of private credit. We'd be trading off of the weaker payrolls number, the increase in the unemployment rate. And we're not talking about the fact the labor force participation rate dropped by 0.5%. And if it wasn't for that, we'd have a much higher unemployment rate. So you're
still calling your sub 4% yield? I mean, forget about the war, the uncertainty, and all that. I don't want to go Bayesian on you, but is Ian Lyngen still modeling out a sub 4% 10-year yield?
Yes, by the end of the year, 10-year yields will be below 4%. It's been delayed, obviously, but I do think the path is lower in rates from here.
You mentioned the labor market, one of the two mandates of this Federal Reserve. How do you view the labor market these days?
In a word, confusing.
Okay.
And the reason that I say that is because we don't know what break-even job replacement is. Powell doesn't know. We've been talking about it. Is it 50,000 a month? Is it 75? Maybe it's 15. All of which kind of reiterates the difference between the household survey and the establishment survey. And the Fed has been focused on the household survey at this stage, which I think is interesting because that's a shift, because we don't know how immigration is truly impacting the labor market. So I'm a bit more cautious about the labor market over the course of the next several months than I think the Fed is at the moment.
Ian Lyngen's folks, to bring us up to this press conference at the Pentagon, Paul and I can see what we have seen now in what, Paul? This will be the fourth press conference, I'm guessing? Just guessing.
8 o'clock a.m. sharp is kind
and
of what Secretary Hicks said.
Yeah, it's not like, Bill Clinton sliding in 40 minutes late, but we're going to stay with Ian Lyngen here. We welcome all of you across America, across Canada. We welcome all of you, Paul, across the spectacular square in Old Montreal, where there's the dark granite. It looks like Mary Poppins, Bank of Montreal.
I know. Awesome.
And across from it is the most spectacular church in North America. It is, it's like Saint-Chapelle in Paris. beauty. Ian Lyngen was Paul Sweeney with Mr. Lyngen.
Ian, I mean, all our listeners, all our viewers, they're paying a lot more at the gas pump just in the last several weeks.
Yes, thank you.
Boy, that feels like inflation. How do you think the Fed's viewing energy inflation in the overall inflation picture? Because, boy, a lot has changed over the last month.
Mm-hmm. So traditionally, the Fed would be willing to look through energy inflation as a volatile series that does have an impact on consumption. It does have an impact on real spending, but because of its volatility, monetary policymakers won't adjust rates because of it. This time might be somewhat different simply because there's a clear recency bias in the market as well as for consumers to look at all inflation as the same, and so that could push forward inflation expectations higher. And that's why the Fed is worried. And as we learned yesterday, the Fed continues to see pockets of tariff pass-through to goods inflation. Yep. And until that has been resolved, I don't think the Fed's going to be comfortable cutting rates.
Tariffs in how long? 4 weeks now.
Yeah.
I mean, you talk about private credit, which is absolutely the case, but tariffs is something.
And the feed through to it as well. Coming up on this press conference as well, how are we going to pay for this war? I mean, how does it dovetail into the Ian Lyngen space? $200 billion was the latest call. Baloney. I'll bet you it's double that. How are we going to pay for this?
Well, Bessent has made it clear that any funding shortfall is going to utilize the bill market to be covered at the moment. And we even have the Fed in doing reserve management purchases, so there's plenty of capacity in the very front end. So in the short term, it's going to be in the bills market. Eventually, of course, coupon auction sizes will have to increase, probably 2s, 3s, and 5s. But on the flip side, we've made a lot more money in revenues from tariffs than I think many were expecting. So the deficit's not in as bad of a place as it might have otherwise been.
One final question. Minnesota did not make the NCAA tournament. I noticed that this year. Nobody's over 6 feet. They were selected for the college basketball crown in Las Vegas.
That sounds like a fun time.
Are you going to Las Vegas to see the University of Minnesota April 1 play basketball?
Now that you mention it, I might.
I mean, well, there it is. I mean, is the NIT still a thing, Paul?
Yes, it is.
It's like a big deal.
It's still a big deal. I mean, it's number 2, but it's still if you win the NIT, that's a pretty good thing.
When do you know to buy price, yield down, price up? I mean, how do you do that within a war? You just have to wait for the headline, the war's over?
Or a de-escalation, an off-ramp for the administration. It's a meaningful development around the Strait of Hormuz.
Okay.
I think all of those are what we're watching.